So today I want to talk about something that most people are completely missing about this war. Everyone is watching the military updates. Everyone is tracking the diplomatic meetings. Everyone is reading about the strikes, the ceasefire talks, and the political statements. But almost nobody is asking the question that actually matters most to ordinary people around the world. And that question is this: what does this war actually mean for your money? Not for governments, not for generals, not for the investors who move markets from private offices, for you, for your savings account, for your energy bill, for your grocery costs, for your job security, for your pension, for your children's financial future. The answer, when you look at it carefully, is that this war is not just a military conflict being fought thousands of miles away. It is a direct financial shock that is already moving through the global economic system toward the bank accounts of ordinary families, and most people will not see it coming because the mainstream coverage is focused on the battlefield, not on what the battlefield is doing to the economy. Depending on where you live, depending on which supply chains your job depends on, and which currency your savings are held in, this war is going to affect your financial life in ways that are very specific and very real. The time to understand them is now, before the full impact lands, not after. So today I want to walk you through exactly what this war means for your money, country by country, region by region, risk by risk. So let us begin. The first thing you need to understand, the foundation of everything I am going to tell you today, is this: every major war in the modern era is simultaneously a financial event. Not eventually, not as an afterthought from day one. That statement is easy to make, but most people do not fully grasp what it means in practice. So let me make it concrete with something you will recognize. When a war disrupts the flow of oil through a critical shipping lane, the price of fuel on global markets rises within days. When fuel prices rise, the cost of transporting every single product you buy, food, medicine, clothing, electronics, rises with it. When the cost of moving goods rises, companies either absorb the loss or pass it to the consumer. In almost every case, the consumer pays. That is inflation. And inflation, as anyone who lived through the 1970s energy crisis remembers, is one of the most destructive forces an ordinary family can face, because it silently reduces the value of everything you have already saved. The question is no longer whether this war will affect the global economy. It already has. Oil prices have moved. Shipping insurance costs have risen. Currency markets have shifted. The question is, which families will face the most financial damage, and which countries will manage to protect their people from the worst of it? The answer depends entirely on one thing: how deeply is your country's economy connected to the supply chains, energy routes, and financial systems that this war is disrupting? The more connected, the more exposed; the less connected, the better protected. Let me walk you through every major region in the world with that framework in mind. Because once you understand where your country sits, you can begin thinking clearly about what it means for your own financial decisions. On the surface, Europe looks like a distant financial bystander to this conflict. The fighting is not on European soil. European governments are not direct participants in the military confrontation. European leaders are issuing careful diplomatic statements while the actual shooting happens far away. But underneath that surface, Europe is the region most immediately and most financially exposed to this war. And the reason comes down to one simple number: 27%. That is the share of Europe's total energy imports that still flows through supply routes connected to the Persian Gulf and the broader Middle East corridor. 27%. That is not a minor exposure for an economy as large and as energy intensive as Europe. That is a structural vulnerability that becomes a financial emergency the moment those routes are disrupted, and Europe has already seen exactly what happens when its energy supply is suddenly interrupted. When Russia cut gas deliveries to Europe in 2022, European household energy bills rose by an average of 54% within 12 months. 54%. Families across Germany, Italy, France, and the Netherlands were making impossible choices between heating their homes and buying food. Industrial companies were shutting down production lines because the energy cost made manufacturing uneconomical. The European Central Bank raised interest rates at the fastest pace in its history, and millions of families with variable rate mortgages watched their monthly repayments climb while their wages stayed flat. If this war disrupts Middle Eastern energy flows to Europe with anything approaching the severity of the 2022 Russian gas crisis, the same chain reaction begins again. Energy prices rise, inflation returns, interest rates are forced higher, mortgage costs increase, job security weakens as businesses cut costs, and the families who were only just beginning to recover from the last inflation wave are hit again. Before they have rebuilt the savings they lost the first time, for ordinary European families, this war is not an abstract geopolitical event. It is a direct threat to the financial recovery that most households have been counting on for the next 2 or 3 years. Now let us look at the major economy whose financial exposure to this war is even deeper than Europe's, but is being discussed far less. On the surface, Japan looks like a stable, wealthy, and well-managed economy. It has one of the highest standards of living in the world. Its companies are global leaders in technology, manufacturing, and automotive production. Its financial system is disciplined and conservative. Japan looks like a country that can handle almost any external shock. But underneath that surface, Japan has a financial dependency on imported energy that makes it extraordinarily vulnerable to this specific conflict. Japan imports approximately 90% of its total energy needs from abroad. 90%, nearly the entire country runs on imported fuel. And a very significant portion of that fuel moves through shipping routes that pass through the Persian Gulf, the precise geography at the center of this war. What does that mean in financial terms for ordinary Japanese families? Consider what happened the last time energy costs spiked between 2022 and 2024. Japan's import costs rose so sharply that the Japanese yen lost approximately 30% of its value against the US dollar. 30% in under 2 years. For a Japanese family with savings denominated in yen, savings set aside over decades for retirement, for children's education, for emergencies, a 30% currency devaluation is the equivalent of a third of your savings evaporating in purchasing power terms. Not through any bad decision you made, simply because your country imports its energy and the price of that energy went up. If this war pushes energy prices higher again, the yen weakens again. If the yen weakens, every imported product, food, medicine, electronics, industrial components becomes more expensive in yen terms. Inflation rises in a country where wages have barely grown in 30 years. And Japanese families face a financial squeeze that the government has limited tools to address. Because Japan's national debt is already the highest of any major economy on earth, standing at over 260% of GDP. For ordinary Japanese families, the financial risk from this war is not theoretical. It is the electricity bill, the grocery receipt, the real value of the pension they worked their whole career to build. Let us now look at the economy that appears to have enormous financial strength but is carrying a hidden fragility that this war is making worse. On the surface, China looks like a financial colossus. The world's second largest economy, the largest manufacturer on the planet, the country that holds an enormous share of global foreign exchange reserves. From the outside, China looks like it can absorb almost any shock and keep growing. But underneath that surface, China is carrying a financial vulnerability that this war is actively making worse, and that most Western financial commentary is significantly underestimating. China imports approximately 40% of its total energy needs from the Gulf Cooperation Council, Saudi Arabia, the UAE, Kuwait, and their neighbors. 40%. That is a massive exposure to the exact supply chain this war is disrupting. But the energy dependency is only half the story. The deeper problem is what is already happening inside the Chinese economy. Chinese property prices, which represent the primary savings vehicle for hundreds of millions of ordinary Chinese. Families have been falling in major cities for over 2 years. In some cities, property values have dropped by 20 to 30% from their peak. For a Chinese family whose entire financial security is tied to the value of their apartment, a 25% fall is not a market correction. It is the loss of years of savings. It is the destruction of the financial foundation they planned their retirement around. If this war pushes Chinese energy costs higher, Chinese manufacturing margins shrink. If manufacturing margins shrink, companies reduce wages and cut employment. If wages fall and jobs disappear, Chinese families struggle to service the mortgages they took out during the property boom. And if a large enough number of Chinese families simultaneously struggle with their mortgages, China faces the kind of financial stress that its government has been managing carefully for several years, but which could become far harder to contain. For ordinary Chinese families, this war is arriving at the worst possible moment. During a period when household finances are already under more pressure than at any time since China's economic rise began in the 1980s. Now let us look at the country with the most structural financial advantages, but also a risk that most people are not paying enough attention to. On the surface, the United States is the best positioned major economy to manage the financial consequences of this war. America became the world's largest oil and gas producer in 2023. Its agriculture sector produces enormous surpluses. Its technology companies generate global revenues regardless of what happens to physical supply chains. And the US dollar is the world's reserve currency, meaning that when global financial markets become uncertain, international investors buy American assets, which strengthens the dollar and actually reduces American borrowing costs at exactly the moment they need to borrow. For ordinary American families, the most direct financial impact of this war is the one they can already see: fuel prices. When oil markets tighten, the price at the pump rises. When fuel costs rise, the price of almost everything transported by road, rail, or air rises with it. That is real, and it affects household budgets immediately. But the deeper financial risk is the one that is not making headlines. America is currently carrying $34 trillion in national debt. $34 trillion. The mechanism that has allowed America to carry that debt without a financial crisis, the petrodollar system, is directly threatened by the instability this war is creating in the Gulf. Here's how the petrodollar works in simple terms. The Gulf states sell their oil in US dollars. Every nation that needs Gulf oil must hold and use US dollars to buy it. That creates permanent global demand for American currency. The Gulf states then recycle their dollar earnings back into US government bonds. That recycling is what helps America borrow at relatively low interest rates despite its enormous debt. If this war destabilizes the Gulf states and they begin accepting oil payments in other currencies, the dollar's global dominance weakens. And if the dollar weakens, American borrowing costs rise. If American borrowing costs rise, the interest rate on every mortgage, every car loan, and every credit card in America trends higher over time. For ordinary American families, the direct impact of this war is manageable. The indirect impact through the petrodollar mechanism is the risk that deserves far more public discussion than it is currently receiving. Now let us look at the region where the financial consequences of this war are not a risk in the future but a reality right now. On the surface, Africa appears geographically and politically distant from this conflict. The war is not being fought on African soil. African governments are not parties to the military confrontation. African cities are not in any immediate physical danger, but underneath that surface, Africa is the region where the financial consequences of this war are most severe and most immediate for ordinary families, and the region that receives the least attention in global financial coverage of this conflict. The reason is straightforward and devastating. Approximately 25 African nations import more than 50% of their food requirements from regions directly affected by this conflict and its supply chain disruptions. Many of these same nations import virtually all of their fuel. Fertilizer, which is essential for African farmers to grow food domestically, is priced directly off the cost of natural gas. When energy prices rise by 30%, fertilizer prices follow within months. When fertilizer becomes unaffordable, farmers plant less. When less is planted, domestic food supply falls. When domestic supply falls while import prices are rising simultaneously, the financial consequence for ordinary families is not inflation in the abstract sense economists discuss. It is the choice between eating adequately and paying for other basic necessities. The bombs are falling in the Middle East, but the financial consequences are landing in African markets, African households, and African family budgets, falling on the people least responsible for this conflict and least equipped to absorb its costs. For ordinary families across sub-Saharan Africa, East Africa, and North Africa, this war is arriving in the form of higher bread prices, more expensive cooking fuel, and agricultural inputs that are becoming unaffordable for smallholder farmers who feed entire communities. And now let us look at the economy with the most to gain from the new global order, if it can navigate this crisis at the right time. On the surface, India looks like the economy best positioned to benefit from the global economic reorientation that this war is accelerating. It is the world's most populous country. It has the fastest growing large economy on earth. Its young workforce, expanding technology sector, and improving infrastructure have attracted enormous interest from Western companies looking to move supply chains away from China. The 2020s was supposed to be India's decade to step forward as a global economic power, but underneath that surface, this war has arrived at a deeply inconvenient time for India's financial ambitions. India imports approximately 85% of its crude oil requirements. 85%. That means every time global oil prices rise because of conflict in the Middle East, India's import bill increases significantly, and that increase flows directly into the broader Indian economy as rising costs and currency pressure. Here's what that means in practical financial terms. India's current account deficit, the gap between what India earns internationally and what it spends on imports, particularly oil, widens every time energy prices rise. When that gap widens, the Indian rupee comes under selling pressure. When the rupee weakens, every imported product becomes more expensive in rupee terms. When import costs rise, Indian businesses face higher production costs and typically pass those costs to consumers. The result is inflation, and Indian inflation disproportionately affects food prices, which take up a much larger share of the household budget for the average Indian family than for families in wealthier countries. For the hundreds of millions of Indian families who have entered the formal economy and the financial system for the first time over the past decade, who have opened bank accounts, started saving, and begun building financial security, this war represents a direct threat to progress that took years of hard work to achieve. So now, let us zoom out and look at the biggest picture of all. Because what we have just walked through, 6 regions, 6 different financial situations, 6 different levels of exposure, is actually one single story told from 6 different angles. And the story is this. The global financial system was built on the assumption of cheap, reliable, freely moving energy. Remove that assumption and the architecture of ordinary household finances. Mortgages, savings, pensions, grocery budgets, energy bills, shifts in ways that families have very limited individual power to protect themselves from. For 4 decades, the deal offered to ordinary families in the global economy seemed straightforward. Globalization would make goods cheaper, energy from the Gulf would keep fuel affordable. Central banks would manage inflation, property values would grow, retirement savings would compound, the world would keep getting more efficient, and ordinary families would feel those benefits in their daily financial lives. That deal is fracturing, not because of one war, not because of one decision made by any one government, but because this war is accelerating the breakdown of the global supply chain and energy architecture that underpin that deal for an entire generation. It is compressing a transition that might have unfolded over 20 years into something that is now happening in 3 to 5. The families and individuals who navigate this period with their financial security intact will not be the ones who waited for things to return to normal. They will be the ones who recognized what was actually changing, adjusted their understanding of risk, and made deliberate decisions about their savings, their energy costs, and their long-term financial planning while there was still time to act thoughtfully rather than reactively. That requires clarity. And clarity requires honest analysis of what is actually happening, not reassurance that everything will be fine, and not panic that everything is collapsing. The truth, as usual, is more specific and more useful than either of those extremes. I want to end with the most surprising financial conclusion in this entire analysis. The one I genuinely did not expect when I worked through the evidence carefully. You might expect me to say that the biggest financial winners from this war are the countries that produce their own oil and gas: America, Canada, Norway, Australia. Countries that can sell energy at higher global prices while the rest of the world pays more. Countries whose trade balances improve every time a barrel of oil gets more expensive. That logic makes sense, and on the surface, it is true. But actually, no. The biggest long-term financial winners of this conflict are not the countries that produce the most oil today. They are the countries that use this crisis as the forcing event to finally seriously and permanently reduce their dependence on imported fossil fuels. Think about what energy dependence actually means for a national economy. It is structurally similar to renting your home rather than owning it. Every month, you pay. Every month, that payment builds no equity and no security. And every year, you remain completely exposed to your landlord's pricing decisions, in this case, the global oil market and the political decisions of the countries that control it. A landlord you cannot negotiate with, cannot appeal to, and cannot replace quickly when prices suddenly rise. The countries that invested seriously and consistently in domestic renewable energy over the past 15 years are discovering something important right now. They are still affected by this war. No economy is completely isolated from global energy markets, but they are less affected, their exposure is smaller, their financial resilience is greater, and crucially, that resilience compounds over time. Every additional solar panel, every additional wind turbine, every additional kilometer of electricity grid represents the permanent reduction in exposure to exactly the kind of external shock this war represents. There is an old concept that historians use when studying empires and nations that manage long-term stability despite external pressure. They call it strategic depth, not just military depth. The idea that you have enough territory and resources to absorb a blow and recover. Financial strategic depth, the ability to withstand an economic shock without your household finances being immediately and severely disrupted. The nations building energy independence right now are building financial strategic depth for their citizens. That is not weakness. That is the most rational long-term financial decision any government can make on behalf of ordinary families. And this war is making it more urgent than ever. So let us just recap what we covered today. Europe, with 27% of its energy imports tied to Middle Eastern supply routes, is the most immediately financially exposed major region. A second energy disruption would arrive before most European families have fully recovered from the first one. Japan, importing 90% of its energy needs, faces a currency and inflation risk that directly threatens the real value of savings and pensions built over decades. The 30% yen depreciation of 2022 to 2024 is a preview of what another energy shock could do. China, despite its apparent economic size, is carrying a deeply stressed property market and a 40% energy exposure to the Gulf. A further financial squeeze could accelerate domestic economic problems that the Chinese government has been carefully managing. The United States is best positioned of the major economies. Its domestic energy production, resource wealth, and dollar reserve status provide genuine protection. But the $34 trillion national debt and the petrodollar dependency are real vulnerabilities. that this war is placing under new and serious pressure. Africa is where the financial consequences are most severe and most immediate for the families least able to absorb them. Rising food and energy import costs are arriving in the form of higher prices for the most basic necessities of daily life. India, with 85% energy import dependency, faces a currency and inflation challenge at exactly the moment its economy was positioned to step into a significantly larger global role. The financial progress of its emerging middle class is directly at risk. And the most important conclusion of all, the financial winners of this crisis will not be the biggest oil producers. They will be the countries that use this moment as the forcing event to build genuine, lasting energy independence and the financial strategic depth that comes with it. This war is not just a military event, it is a direct financial shock to ordinary households around the world. The question is not whether your finances will be affected. They will. The question is whether you understand how, so you can make informed decisions while there is still time. And tell me in the comments, which country do you think will come through this crisis with its household finances most protected, and which one do you think is most at risk? I read every comment. I will see you next time.